Paul is a senior fellow at the Harvard Kennedy School and at the Harvard Business School. He was Deputy Governor at the Bank of England from 2009 to October 2013, having joined the bank in 1980. Paul was a member of the Bank of England Statutory Policy Committees, the Monetary Policy Committee, Financial Policy Committee, Prudential Regulatory Authority Board, as well as its Court of Directors. In addition, internationally, Paul was a member of the Steering Committee of the G20 Financial Stability Board and chaired its Committee on the Resolution of Cross-Border Banks in order to solve for the too-big-to-fail problem. He was a member of the Board of Directors of the Bank of International Settlements and was chair of the Basel Committee for Payment and Settlement Systems from April 2012. Paul is a visiting fellow of Newfield College, London, and a governor of the Ditchley Foundation. So please join me in welcoming Paul to the stage to deliver his keynote address.
Thank you, Kathy. Thank you, Greg, for inviting me here today. I shall say something about how we work together about a third of the way through my remarks, and to the other commissioners as well, some of whom I've known for a very long time. It's really good to be here, and it's very, very nice to be in Australia again. Well, regulation and growth. I guess there are lots of people in the industry who believe that regulation suffocates growth. But we should be optimistic about this. And in an age where our generation finds itself confronting globalization, demographic change, technological change on a scale that who would have dreamt of, we should keep faith in the fact that liberal democracy and market economies have been the best providers of prosperity and human dignity in the history of the world. And if I say things that suggest that I've become skeptical about that, I haven't. When we talk about market regulation and growth, typically we say things about protection of investors, the efficiency of markets, the formation of capital, and in particular we talk about primary markets and secondary markets as allocators of resources, and all of that is true. But there is something that we don't say, and I think that we should say it more often, and it's about risk distribution and sharing. So if you step back and think about the three fundamental functions of the financial system, the most elemental is a payment system. Remember that the US had to adopt barter for a while when they had bank holidays in the 1930s. The second is the allocation of resources, and the third is the distribution and pooling of risk. And we tend to think that that's something to do with insurance or even these funny things called derivatives. But actually, it's what equity markets do too. So imagine that there's a business in Sydney, all of its business is in Sydney, and it issues some equity. And half of the equity is bought by the residents of Sydney, and half of the equity is bought by the residents of Melbourne. And then something kind of bad happens to the economy in Sydney. The really important thing that's happening is that the residents of Melbourne are picking up some of the cost. Now, that may sound far-fetched, but let me contrast the continents of the United States and the continents of Europe. The greatest engine for risk transfer in the United States is not fiscal policy and federal-wide unemployment benefits, although they unquestionably help. It is the capital markets. As continental Europe, or in fact the EU as a whole, contemplates developing a capital markets union, the most important thing for them to do is develop an equity market where people in Naples will be holding the equity of companies that are operating in Latvia or Belgium or Scotland or Ireland. And I think this is something that connects with my main theme. I think first of all it should be reflected in the missions and mandates, the declarations of securities regulators more than has been the case over the past half century. But I think it also is one way of thinking about why securities regulators are unavoidably in the business of financial stability, which they are, and which I think to varying degrees around the world presents securities regulators with cultural, legal, know-how challenges. It's easy to think of the reform of the global financial system since the dark days of 2008, 2009 as being principally about banks. And up to a point, that's true. More capital for banks, more liquidity for banks. Can we resolve banks on a cross-border basis? I was closely involved in that. And for those of you that are bankers, I have to say that what this is partly about, particularly the resolution thing, is it's about making banks part of capitalism again. Regulators believe strongly in capitalism. Regulators, more than bankers themselves, do not want banks to be part of a semi-socialized economy. If bankers could just embrace capitalism again, the world would be a better place. So there's an awful lot going on about banks, and you did, and the man sitting at the front did a great job in preserving the stability of your banking system, John Laker. But it isn't just about banks. The reforms internationally also cover clearinghouses. This is going to be a massive thing for you all over the next generation. Banks became too big to fail by accident. Clearinghouses have become too important to fail by mandate of the G20 leaders. This is the first time anyone has done anything like that for about 200 years. If and when a clearinghouse fails, and 3 clearinghouses have failed in history, 2 of them in this part of the world, one in Hong Kong and one in Kuala Lumpur, people will get very angry indeed. And they will look back on the decision taken by the generation above me to allow clearinghouses to be for-profit institutions, and will ask themselves whether that was a sensible thing to do. I kind of throw that out there. We have decided that we need to know more about what goes on in derivatives markets in order to track the risk in the financial system. This was a worthy project. It has ended up with, I mean, I'm not in office anymore, so I'm not quite sure, but somewhere between 15 and 20 major trade repositories around the world. Unless they can speak to each other electronically and people can extract the information from it and do holistic analysis of the financial system, that project will have failed. And it is now fragmented partly because of the, again, interests of for-profit companies. There are steps to set minimum margin requirements in derivatives markets, to set minimum haircuts in repo markets and securities lending markets. This is the analog to equity requirements in the banking markets. It feels and looks like an intrusion of the state into markets that didn't exist before. But the truth is that the systemic spillovers of these things going wrong is that it can't be left entirely to the market. Even a kind of minimal state has to recognize that there are spillovers which private parties won't factor in to their choices. I could go on about the existing agenda, but there's another dimension to this as well, which is that the implications of re-regulating banking is going to affect securities regulators as well in quite powerful ways, one of which we're already seeing quite a lot of talk about. So, whatever one thinks about the Volcker rule in the United States, people seem to believe for the moment that the much more restrictive leverage requirements on banks is going to impair liquidity in bond markets. And a number of people are very concerned about this. And I do think, as I shall say in a moment, that the road is going to be bumpy. But ask yourself, when we had market makers who could stretch their balance sheet with kind of infinite elasticity, these dealers were, in Europe and the United States, probably levered about 150 times, if you measure it correctly. Markets were terrifically liquid until they weren't in 2007. And I'm not really sure that the world is a safe place, that our citizens are safe. And it's the citizens that have taken the cost in Europe and the United States, not people like me from the official sector or people in the financial sector. When the liquidity evaporates, everybody is worse off. Now, the real issue here, I think, is that the most pernicious booms are the slow, gradual ones, and the last one lasted a generation. And one consequence of that is that there was systematic underinvestment in market infrastructure. And by investment, I don't just mean dollars, I mean ideas and thinking. If I think back to Paul Volcker's generation of central bankers and Nick Brady's generation of treasury secretaries, they thought more about market infrastructure than the generations that followed them. And those of you in office now, you need to return to that, and it will be a slow motion. It can only be a slow motion project. The other element, and I think this is the most potent of all, is that as banking is re-regulated, so activity will shift out of de jure banks into other forms of financial intermediation, whether it's firms or chains of transactions. And excess leverage, excess maturity mismatch, liquidity risk will be manufactured in those structures. And in one sense, that's the dynamism of a market economy, and not a bad thing at all. The important thing today is that most of those things in many jurisdictions are going to be regulated by the securities regulator, not regulated by the banking regulator or by the central bank. And that presents challenges of mandate, culture, parliamentary oversight for securities regulators. And I think this is quite difficult, even if you embrace it, which I know Greg does, and Stephen Mayor, the head of ESMA, the European Securities Market Authority, does too, because it's difficult to get up in the morning and be worried both about wickedness and about stability. I mean, there is some common sense in the view that having agencies focus on one big mission has virtue of focus and incentives and oversight. But it is not within reach. You cannot escape this part of your mission, because you will be the only people with the powers that exist to contain these sources of systemic risk. And it means focusing on the big things rather than the small things. Now, it does not follow from what I'm saying at all that everything needs to be concentrated in the central bank. I think this country, more than any other advanced country in the world, has shown that you can operate a twin peak system with a central bank, a securities regulator, and a prudential regulator. I think it puts a premium on grown-ups and on grown-upness, and I think you've been fortunate as a country to have grown-ups at the head of those institutions for a number of years. And if there's anything that people those of you in the room should try to ensure in the years ahead, it's encourage the leaders of these organizations to be grown-ups and understand their mutual dependence. And for those of you that follow these things, ignore the precepts of the new public management that say we must put agencies in boxes and not have them blurred lines. Blurred lines are good. Overlap is uncomfortable for bureaucrats. It can be presented as turf wars, and it can be threatening to the people in the organizations. Underlap is bad for the citizens that you serve. Now, before I change tack to the international part of all of this, let me say this is not just about standard financial risks that central bankers typically care about. As Greg has said, it is most definitely about cyber as well. In the year before I retired, at the end of 2013, I was very, very anxious to get cyber onto the agenda. And I think it's something the official sector more or less has to lead, because the amount of money that any individual firm is prepared to spend on cyber protection will depend upon what you think your competitors, not only in this country, but in other centers and around the world, are doing. There is a collective action problem, and the state exists partly to address collective action problems. But have no doubt that for some time now, there has probably been a capability for financial systems to be switched off. That's the main point I want to make. This isn't just about somebody may rob your checking account or current account, as we call it in the UK. You may get up one morning and find that a financial sector of some economy, near or far, has been closed down temporarily by some hostile power, which bridges to the international part of this. This is all unavoidably international so long as we don't have capital controls. There are some of us in the room who are old enough just to remember a world of capital controls. I joined the Bank of England in the year after the UK had finally lifted the exchange controls that had been in place during and after the Second World War. But as long as capital flows freely, you are all in it together. The spillovers from one financial system to another and one economy to another are rapid, complex, and most of all, real. Stability is a global common good. It's sometimes called a global public good, but that's actually not quite right in the economics. It's not something that you guys produce. It's something where you have to hold hands and solve a collective action problem. And this is 30, 40, 50 years ago, this would have been seen as something that went on in the Basel Tower following the creation of the Basel Supervisors Committee in 1974 after the failure of Herstatt Bank in Germany and of, I think, Penn Central in the United States, or was it Franklin National? Franklin National. Well, it's no longer just a Basel Tower thing, it's an IOSCO thing too. The International Organization of Securities Commissioners. And that community is lucky to have Greg as chair of IOSCO, and the central banking community has been lucky to have Greg as chair of IOSCO. And one of the things that it has been, I was proud to be part of, but more importantly, it is very good that it has happened, is that IOSCO and Basel are learning to work together. And we co-chaired the steering committee that oversees the Central Banking Infrastructure Committee and IOSCO. And there is a risk in democracies that that kind of international work is invisible domestically. I used to worry, and I still worry in my new life, that democratically elected politicians naturally focus on the things that they themselves are responsible for. In the United States, Volcker looms large. In London, the Vickers rule looms large. Both of these things are important parts of the reform program, but they are not absolutely the core of the reform program. The core of the reform program has been produced internationally, and I would just encourage you to do everything you can to ensure that Parliament and most of all the public understands this. Now let me say a few more substantive things. We have lived in an age where, and it wasn't always like this, but we have lived in an age where, for completely good reasons, legislators and the public have not wanted to grant huge discretionary powers to regulators, because that way lies tyranny, the arbitrary power of the coercive state exercised by people that weren't even elected. What this means in practice, because that sounds rather highfalutin, but this has a real manifestation that affects all of you, and which some of you unquestionably exploit, which is detailed rule books. Because you don't want to just give Greg power and say, make the system safe, here's an objective. You want to say, Greg and commissioners produce detailed rule books, have notice and comment rulemaking, as they say in the United States, and then leave the rules there. This cannot possibly work to sustain the stability of the financial system, and I think this is a massive challenge to regulation in democracies. Let me give you two kinds of example. The first is whether it's bank capital requirements, bank equity requirements, or it's minimum margin requirements, minimum haircut requirements in the capital markets. The underlying thought is that you've got to decide, the politicians ought to decide what probability of systemic risk you're prepared to tolerate. And I'm going to put that to one side. And then secondly, how risky the world is. And you can think of that, those of you techie-minded, you can think of that as an underlying stochastic process that churns out tails with some probability. But the problem is you can think about this underlying risk-generating process as having three modes: normal, exuberant, and depressed. Well, if we calibrate all of our regulatory requirements to exuberant, we will worry that we will choke off credit, the flow of risk, the flow of capital, and undermine our objective of growth. And we don't know enough about the world to know how probable that is, but we know that growth matters enormously. And so we calibrate to normal. But we should also know that if we calibrate to normal, our capital requirements or our margin requirements or our haircut requirements, they are not going to be enough when the system gets into one of its exuberant phases. They will not be enough. If you calibrate to normal, when the system gets heady, when it becomes irrationally exuberant, as Greenspan and Schiller like to call it, then those regulatory requirements will not be enough. And the only way to keep the system safe, by which I mean the only way to keep the system in line with the desired degree of resilience that the politicians, the public regulators have decided is warranted, is to increase the requirements. And not to increase the requirements after, I don't know, 2 to 3 years of notice and comment rulemaking, but to increase the requirements temporarily, but fairly promptly, and then to bring them back later on. And this is, by the way, not so much about fine-tuning the credit cycle, which I think is beyond the wit of men and women. It's about sustaining the resilience of the financial system that you want, so that when the bubble bursts, it's unpleasant, but the ceiling doesn't collapse, creating the kind of mess that we saw in the United States and Europe. But what I've just described sounds more like monetary policy than standard securities regulation. And when I was, 25 years ago, when I was helping to redesign the Hong Kong securities regulatory system, this would not have crossed my mind. But I think it is part of what you face. And as you debate how you are funded and how independent you are, I think this is important for you. Because a world in which a securities regulator goes to its minister or its parliament each year for budget approval is not a world in which you will be able to do that easily. There is a reason why central banks have the degree of independence they have. If you are now in the same game, you need a similar degree of independence and funding structure. Let me finally make a different point, which bridges from stability to conduct. It also starts with the point about static rules. Regulatory arbitrage is endemic in finance. It is completely endemic. In lots of your businesses, there are people today thinking about how to find their way around the rules designed to make the system safe. Finance is a shapeshifter. The implications of this are enormous, I think. And I think it's taken me a while to appreciate this. So it undermines our faith in rules. It undermines our faith in the objective of the regime. It distracts firms from serving their customers. It requires regulators to allocate resources, more resources, to chasing after this kind of activity. But it does something more profound as well. And by the way, all of that's pretty big stuff. I worry that it breeds cynicism about rules and regulations. I worry that it breeds cynicism about even the rule of law and order. If young people especially, join an environment where it is fair game to find one's way around the rules designed to make one's bank safe or one's client safe, how confident can we be that they will know where the line lies between staying within the law and breaking the law? I'm afraid for the moment, I have ended up thinking that the stability regulator's concern about regulatory arbitrage is related to the conduct regulator's concern about culture. I would like the leaders of the industry to go back to their desks or over the next few months and say, we are no longer going to approve the degree of regulatory arbitrage that we have allowed our employees to engage in for more than a generation. Because given the size of firms, if that is the culture, we don't know how to keep our people honest. And if we don't know how to keep our people honest, there will be no steady growth that serves the interests of the people. Thank you very much.